Hi everyone, Mathis Connor here with Connor Management Group, and we're going to do something a little different for this video and podcast. Basically, we want to explain to you why we pick the stocks that we pick. We usually give you a bunch of facts, but I just wanted to drive home what is the primary reasons behind all of our picks. And to summarize it very simply, it is stock selection and our process. It is always about valuation. It is always about valuation. It is always about valuation. On the slide, what you'll see is a picture of a white wooden water bucket sitting on some smooth rocks. And above the bucket is a spout, water spout connected to a beige rectangular wooden post. It's a very zen-like scene. And I would like to just use a simple analogy that we think is pretty appropriate for explaining valuation to you. And we hope that this will give you deeper appreciation for what we do, and will help you learn to listen to other people and see that when they recommend certain stocks, if they do talk about valuation, because at the end of the day, we all want to buy a stock for it to go up in price. And if there's no good reason for it to go up in price anytime soon, why buy it? So that's the picture we have at the top. Picture of this bucket of water being filled from this fountain. And below that picture, we have a picture of a graph with 3 lines on them. And left to right of the graph are just an example, months 1 through 12, and the y-axis that's going up and down. We have the stock price. We have one line where the stock price stays at $40 throughout the 12 months. Another one starts at $40, jumps to $55. Another one starts at $40, drops to $20. So, okay, let me get at what this whole valuation is about. For this water bucket, what I want you to do is just imagine for a minute that the water bucket is just full. It's just filled with water, and it's just holding that water, and it's just at one level. The water is filled up halfway, and that's where the water line is. You could view that as just being the static value of a company. So, for instance, if you know that water bucket is just staying at that level, then you could just picture that as just being a company that's worth $40. Nothing's changing, nothing's going on. It's just $40. Well, in reality, we know that for companies, things are always going on. Profitable company, even not necessarily profitable company, he always has revenues, and you can view those revenues as a water spout filling the bucket. And for this scenario, assume that there's a small hole in the side of the water bucket, and the size of that hole changes over time. Maybe it gets bigger, maybe it gets smaller. Well, as you can imagine, if the water bucket starts filling fast from a lot of water coming in, and the size of that hole on the side doesn't get any bigger, then you can imagine that line of water is going to go up more, obviously. Similarly, if that hole in the water bucket gets just as big as the water coming in, or gets bigger, you can imagine over time that level of water is going to fall. And that is a perfect example of what valuation is about. Essentially, that if the water line goes up, you can imagine the value of the company is going up, and so the value of the stock will likely go up. Similarly, if the water is flowing out more, then you've got water coming in, that level of water, the mid level of water is going to start to decline and decrease, and therefore you expect the stock to decrease. So, of course, the water coming in represents cash coming into the company. Water going out represents expenses, money going out of the company. And where that level of water is represents the value of the company. Hence, going up, the stock goes up. Going down, the stock goes down. So, how do people use that information to say, well, is this a good stock or not a bad stock? Well, as I said, is that if nothing was going on, you could assume the stock price is at $40. And if you look back far enough in time, you can kind of assume, like, well, based on these financial relationships, this is what the stock price should be. And those relationships are known as valuation metrics, and you hear me talk about them on the YouTube videos as well as the podcast. And then different kinds of valuation metrics that people pay attention to. If you listen to the financial press, you'll often hear about price to book, the price to earnings, the trailing price to earnings ratio, or price to earnings being the forward price to earnings ratio. You'll also hear about the price to sales ratio, and the PEG ratio, the enterprise value to revenue ratio, and the enterprise value to EBITDA ratio. I mean, those are 6 fairly mainstream ratios that people pay attention to. I mean, the top 3 are the price to book, the price to earnings, and the price of sales. People also pay attention to the others, but they're usually considered to be more secondary. So you've got a stock, or you have an investment manager that's following the stock, or a research analyst, they really want to know, okay, is more cash going to start coming into this company than is going out? Effectively, in a very simplistic term, that is what they want to know. Is the level of that water going to increase? Is the amount of cash that this company has, is it going to increase? Now, right, I'm saying cash, but in reality, that cash is represented by buildings, equipment, and cash, as well as other things for the company to operate on. So this is what analysts look for. And if you're tracking this to say, like, okay, what's going on with this company? Do I have good reason to believe that more cash is going to start coming in than going out? Then I'm going to believe that the stock price is going to go up, and vice versa. If I believe that more cash is going to start going out than coming in, even small changes, I'm going to believe that stock price is going to go down. So basically, the good investment managers will look ahead. They'll say, what is the consensus thinking? What are most research analysts thinking? What do my models say? What is the news telling me? What are the government reports telling me about this industry and or possibly this company? And even based on the quarterly reports these companies give out, does that tell me that this stock price should be going up or should it be going down? So the good investment manager, research analyst, and investor, he or she is trying to say what's likely going to happen before it happens. Now, if you watch very closely, you can just be reactionary and see that the stock's moving up. I'm going to jump on the stock, and hopefully I'll keep going with this momentum and it will go up. Similarly, if you were going to short the stock, you could say, well, I'm going to bet that it's going to go down. It's starting to go down, and I'm going to go with it. But are you, the researcher or investment manager, really taking an objective look to say, what's the future earnings going to look like? And how do those valuation metrics in the future compare to valuation metrics historically? So, for instance, for all of our stock picks, we look at what has been the average valuation metrics across several different metrics. What's been the average historically? What do people believe is going to happen in the future, and how are those metrics going to change in the future? So, by looking at a difference, looking at, say, the scenario where the stock price stays at $40. Well, if the metric is where it is right now, and it's where it has been historically, and that's at $40, if 6 months to a year from now, it's expected that metric to be the same, and then you would expect that stock to still be at $40, and so why buy it? I don't care how many commercials you hear or how many rumors you hear. If the equity analysts aren't buying it, you don't hear it from management that these metrics are going to increase or decrease, then a lot of that other stuff is really kind of irrelevant, quite frankly. And sometimes, it could just be rumor. I mean, some people believe that social media can help tell you what's going to happen with a stock. Well, I believe that maybe they can tell you what's going to happen for short term, and that short term might be a week or two. But long term, you really have to listen to the professionals who have the accounting and finance backgrounds and really know how to translate and say what are those metrics expected to be somewhere near term in the next 6 months or even 1 to 2 years. So that is what really drives our stock selection. At the end of the day, it's always about valuation. It's always about valuation. It's always about valuation. We pick stocks where in the future the general consensus is that these metrics are going to move in a favorable, are going to make a favorable change for us to recommend to you to profit from. So that probably ran longer than I wanted, but I hope it helps explain the driving principles behind our stock selection process, and I also hope it will make you start to listen with a sharper ear when you're listening to other people make certain types of stock recommendations. Because at the end of the day, it's all about value. Take care. Talk to you soon.